Hello and welcome. You're watching NewsX Explained with me, Vineet Malhotra, and today we take a look at a number that really grabs headlines but quietly decides how strong India stands in a volatile world. When global markets panic, when oil prices spike, when the rupee comes under pressure, this is the shield India reaches for: India's foreign exchange reserves. So what exactly are Forex reserves? Why does India need them? And how strong is India's buffer today? Well, this is what we look at tonight. At its simplest, foreign exchange reserves are cash and other reserve assets such as gold and silver held by a central bank. In India's case, the Reserve Bank of India, these reserves are primarily held to balance payments of the country, influence the foreign exchange rate of its currency, and to maintain confidence in financial markets. Essentially, these reserves are held in foreign currencies in the form of banknotes, bank deposits, and government securities like bonds and treasury bills. Some also hold them as gold reserves, special drawing rights with the International Monetary Fund, and reserve tranche position at the IMF. Together, this pool gives India the ability to pay for imports, service external debt, stabilize the rupee, and handle global financial shocks. They act as the first line of defense in case of an economic slowdown, even as their acquisition has its own cost. Global trade does not run on trust, it runs on hard currency. Foreign exchange reserves facilitate external trade and payment and promote orderly development and maintenance of the foreign exchange market in India. India imports crude oil, natural gas, fertilizers, electronics, and defense equipment, among other key goods. All of this is paid in foreign currency, mainly dollars. So when exports slow down or global capital pulls out, Forex reserves ensure that the ships keep unloading at Indian ports, fuel keeps flowing, and markets don't panic. In central banks' accounts, foreign exchange reserves are called reserve assets in the capital account of the balance of payments. But what exactly do these terms mean? Well, in international finance, the capital account records the net flow of investment into an economy. This consists of the total new investments from abroad minus any capital leaving the country. It thus represents the real change in foreign ownership and capital presence within the country, crucial for economic growth. How essential foreign exchange reserves can be is thus clearly laid out in front of us. But what comprises an adequate reserve for a country is the big question. Well, the IMF proposed a new metric to assess reserves adequacy in 2011. This metric was based on the careful analysis of sources of outflow during crisis. The IMF estimates how much foreign currency a country might need by looking at how different parts of the economy move together. These include exports, imports, and capital flow. This metric also considers the chances of rare but severe shock. If a country has more foreign exchange reserves than this estimated need, it is less likely to face a financial crisis. Even in the event of such a crisis, people and their spending and living standards are less likely to fall sharply. Now, before we come to India's current holdings, it is also important to consider lessons from India's history. To understand why India guards its forex reserves fiercely, we have to go back to 1991. In 1991, India's foreign exchange reserves had fallen so low that the country had barely 2 weeks' worth of import cover. The situation was such that gold had to be present. So what exactly do India's foreign exchange reserves consist of? Let's break it down. Well, the first and biggest chunk are the foreign currency assets. This includes US Treasury bonds, bonds of other governments, and deposits with foreign central banks. These assets earn interest and are highly liquid. Today, India's foreign currency assets stand at $550 billion. The second part comes from gold reserves. India holds hundreds of tons of gold. This gold acts as a hedge against inflation, protection in case currencies lose value, and a trust asset during crisis. When paper money shakes, gold stands firm. The most recent example of this is when RBI's Forex reserves rose following the first week of January, lifted by a 1.6 billion jump in gold and its value, which offset a 1.1 billion fall in foreign currency assets. Currently, gold reserves stand at $112 billion. The third part is special drawing rights and IMF position. These international reserve assets can be drawn during balance of payment stress, and while they are not used daily, they are crucial during emergencies. As of January 9th, India's foreign exchange reserves stand at $687 billion, following a jump of $392 million. And according to the Reserve Bank of India, in fact, over the past few weeks, India's Forex kitty has been largely in an uptrend, barring exceptions. India's foreign exchange reserves are considered highly adequate by all metrics, providing strong coverage for imports and external debt, acting as a crucial buffer against the Forex kitty increased by about $56 billion. And according to data, comparatively in 2024, reserves rose by just over $20 billion. Stability. They also come with their own costs. Reserves earn low returns, and holding too many dollars can expose currency risks. Sterilization costs, that is the monetary policy tool used to offset impact of foreign exchange interventions on domestic money supply, also impact liquidity. And so a strong Forex reserve is about balance, not just size. India today sits amongst the top 5 Forex reserve holders globally. It is placed alongside China, Japan, Switzerland and Russia. This was not built overnight. India's reserves grew rapidly after the 2008 global financial crisis, during years of strong capital inflows when oil prices were moderate and exports were rising. Even during global shocks like the COVID pandemic, the Russia-Ukraine war and Middle East tensions, India has managed to defend its reserve position. This alone signals macroeconomic stability. Let's put India in global context now. China's reserves are export-driven. Japan's reserves are trade surplus-backed. Most oil economies build reserves from energy exports, but India's case is unique. India runs a trade deficit, imports energy and depends on capital inflows. Yet, it maintains high reserves through service exports, remittances, strong financial inflows and a disciplined monetary policy. This is not accidental, it is structural reform at work. But several risks also loom. India imports most of its energy, and a prolonged oil shock drains dollars fast. Another factor is global interest rate cycles. When US rates rise, foreign investors pull money out of emerging markets. Geopolitical conflicts also disrupt trade routes, capital flows, and currency stability. This is why Forex reserves are watched like a hawk. Now you must be wondering why this matters. How do foreign exchange reserves affect you and me? Well, Forex reserves impact the value of the rupee, inflation, fuel prices, foreign travel costs, education abroad, investor confidence, and even job creation. When reserves are strong, inflation is easier to manage. Markets stay calm and growth stays resilient. On the other hand, when reserves fall, currency weakens, imports get costlier, and inflation rises. This isn't abstract economics, it's everyday life. So the next time you hear that India's forex reserves have risen or fallen, remember